I am SoCar, and we are looking at my Robinhood account at the moment. I believe that I probably had the video. I was in the market a couple of years ago, almost 2 years ago. It was January of 22, and I posted the video of I took my $600 account and I got a couple of wins. I got it up to like 1,400 something, somewhere in there. And then right after that, a couple of days later, I was trading and I made a rookie mistake, blew up the account. I think it has like $60 in there now. I gave most of it back. And I hope that I still have that video, and I think I do. And if I do, I will for sure post it, because my losses are more valuable both to me and to anyone watching than my wins are, because when you make your mistakes is where you learn. And so hopefully I have it, and if I do, I will for sure post that video, because we want to see how I blew up the account. So yesterday I had a friend over and we were talking about options. I have a different friend that we're going to be getting back into the market in hopefully in a week or two. And it's going to be a little bit bigger account. It's definitely not a large account by any stretch of the imagination, but my small account was funded with $600, and I was trading futures, which that's about as small as you can be and still trade a futures contract. This one is going to have a few thousand in it. It's going to be a little bit bigger, so there will be enough buffer room to hit that first loss and be okay. So we'll be able to continue trading even after the first loss, and everybody's going to make the losses. So what we're looking at right now, though, is my Robinhood account, and this is definitely a small account. My buying power is 192 right now. My total account size in Robinhood, I think, is 241. I've got a option in SPY that's just sitting there that I'll probably be closing out on Monday. I'd have to go look over there. Anyway, so my friend came over yesterday. He was talking about some options, and he wants to start doing stuff. So what we're going to look at first is SLV, iShares Silver Trust. This is an ETF, an exchange traded fund, and they track silver. So basically, what happens to the silver commodities market will happen to these guys, and they just have affordable shares. And so it works just like a stock, but we can access silver without having thousands of dollars in a margin account in order to pick up an actual commodities contract on silver. Now, obviously, if you're in commodities and you pick up the actual contract, you're making a lot of money really fast, or losing a lot of money really fast. Whereas here, it's just stock. It's just stock. It's just that this particular stock trades the same as silver does. So, quick disclaimer that everybody has to give. I'm not giving advice. I do not recommend that you mirror these trades. I am going to make some live trades. For me, it's Sunday, so the market's not open. I am going to actually input the orders, though, and we're going to see what happens on Monday, and hopefully they all get filled. So not advice, but I believe that it is beneficial to share my experience. It's beneficial to share my wins. It's beneficial to share my losses, because that way we can all learn and grow together. It'll be awesome. And then hopefully all of us can become better traders for the future. And that's the idea. But no advice, not telling you what to trade. So having gone through the legalities there, what we're going to do is we're going to look at options. Actually, we're gonna go back. We're gonna say advanced. Here's a couple of indicators. There's more than a couple actually, but the chart isn't too messy. The green here is the price action, and then the blue line is your moving average. The 10-period moving average. This is the 50-period moving average. So the short leads the long, meaning that because this is above this, the 10 is above the 50. We're theoretically in an uptrend. This line here is that the VWAP? 2635. Oh no, that's the 50. What is this? 2617. Oh, that's the VWAP. What? Oh, it's because it's the 1 day. This is the VWAP. This is my favorite indicator, and there's no such thing as a perfect indicator. There's not any single indicator that you can just bet money on, like going down to Vegas, which is where I live. I'll make a lot of betting jokes because I live in Vegas. And I'm particularly good at roulette. But you can't just go down and bet on red and black and make money, because that's just not the way it works. And the same thing with any trading indicator. You can't just bet red and black on the VWAP. You can't just bet red and black on the RSI. You can't just bet red and black on the MACD. These indicators certainly exist to help us get an insight into the market, but not a single one of them is reliable enough to make bets on and take home money with. But the VWAP is one of my favorites because it's a volume-weighted average price. It takes into account the volume, and that's a huge part of trading and seeing what's really going on in the market. So that's why I like the VWAP so much. But generally speaking, the short version is the price is trading above the VWAP, you're generally in a long trend. If it's trading below the VWAP, you are generally in a short trend or a downtrend. So the 10 versus 50 here, they're converging, so we might expect a turnaround, but right now you're looking at a long trend. It's solidly above the VWAP, you're looking at a long trend. Your RSI is in the upper end here, so you might be expecting a turnaround soon, but it's in a long trend. Your MACD, well, that's anybody's guess. Those things are two pieces of spaghetti that got stuck together when you're cooking them. I don't know which one is above which one down there. So that's not really all that helpful. So let's take a look at the bigger areas here. The weekly, you got some consolidation that you can start to see a little better now. VWAP is here, so again, that suggests an uptrend. The 10 versus 50 suggests an uptrend. Your RSI is where it was. It's technically an uptrend, but you might be expecting it to turn around. And the MACD is a little easier to see here. Your short, is that the one? MACD 1269.03.04. Yeah, you would expect this to be turning around any moment now. So we got a couple that say probably turn around, and then we've got like 3 that say it's in a long trend still, in an uptrend. 1 month, pretty much a similar thing here. The line is now red for price action because for the month it's down. It's down, $1.83. Not huge, I guess. So that's an uptrend, and okay, so when we're looking at the month, now the RSI is way up here. That indicator says you should expect a downtrend. You should expect it to turn around somewhere in the near future. And then the MACD is still pretty convergent up here, so that just says, if I were looking at just this MACD, I would say, okay, cool, if you're long in a position, go ahead and stay long, but I wouldn't go long, because you're expecting a turnaround. So we got a couple of indicators saying, oh yeah, we're long term, we're good, let's buy. We have a couple of indicators saying, we might be selling soon, but we don't have any that says sell now. Okay, let's look at some options. So there we are. Let's look at if I'm bullish on this, because there were a couple of indicators that said it's an uptrend, it's still in its uptrend. Let's go long. Let's do this. Now we got a couple of options that we can do. We can buy a call option, and this particular call option is right at the money. It's 48 cents out of the money, and it's going to run 19 cents, which of course in option speak, that's actually $19, which you can see right here. Because it's 19 cents per share, it covers 100 shares, so it's $19. Usually when I'm talking about this stuff, I'll say cents. If I accidentally switch back and forth between cents and dollars, I apologize. But understand that if I'm saying cents, it's per share, and if I'm saying dollars, it's just the whole transaction put together. And I think a lot of people actually do that. They switch back and forth interchangeably, but I'll do my best to stay consistent for you. So we can just buy this option right here, and that gives us the option but not the obligation to later buy stock at the $27 strike price. That's the price that we agreed to enter this contract at. Price comes up, let's say it goes to, I don't know, 30 bucks, why not? I can exercise my option to buy 100 shares at 27 and then just immediately sell them back into the market at the $300 price point, or whatever they're worth when I exercise my option. And over here in the profit, you can see that as the price goes up, the profit goes up. It just keeps going up, and the max profit here is listed as being unlimited because it's theoretically unlimited. In theory, this price could shoot right up to $5,000 a share. It's not going to, but theoretically it's a possibility, so that's why they say it's unlimited. Realistically, that particular option, if this thing just spiked up, it would really be capped at around, I don't know, maybe $1,000, maybe because at that point you'd have to be coming up $1,000 is 1,000 cents is $10. You'd have to see this spike up to like $37 a share. That's a pretty sizable move. That's a 30% increase. So I mean, that's a theoretical upper end that I would say, but unlimited means theoretically it could go on forever. Now, the downside of this is I got to pay 19 cents for that. Now, some of the options that we'll look at will be a little more expensive than this. We're going to look at QQQ next. I'm actually in SPY right now, and I've got just an option like this, and I think it's even a call option. It's a little out of the money, but we'll look at it in a minute. So, but that can be expensive. 19 cents, no big deal. That's 19 bucks. I mean, if you have anything at all in Robinhood, you could afford to buy this. But if we want to make it a little cheaper, we could then also sell the one right above it. So now instead of costing approximately 19 cents, I'm putting out 19 cents, I'm bringing 5 back in, and this the total cost is going to cost me 14 cents per share, which is $14. And of course, this is approximate because it's putting the offer in at between the bid and the ask spread, but it'll be something right around there. So now I have the ability to get into this spread, and if we go to the builder, it would look like this. It's a call a debit spread. Debit means that I'm spending money on it. The call credit spread means that I'm bringing in a credit to my account. So I'm in this case, I'm selling the call that's closer to the money, and I'm buying the one that's farther out of the money for coverage. So that's what we're doing. We're just creating this call debit spread. So let's go back. And when I had this set up, I deleted it because I said builder. So we're going to buy the call right here for 19 cents. We're going to sell the call right here for 5 cents. Bam, I'm in the trade for 14 cents. So what does that mean? That means if I'm wrong and this site comes down, one moment. All right, sorry for the pause there, roommates and all that. So let's see, we buy this one, we sell that one, 14 cents is what we're paying to get in. Okay, cool. So I'm doing this because I expect that the price of SLV is going to be coming up. I liked those indicators that said it's in a long trend, it's just going to keep going, let's do this. So if I'm wrong, and the RSI and the MACD and the other indicators that said, yeah, I might be starting to turn around, and it comes down, now I'm going to lose some money. But the most money I can lose here, you can see anywhere here, the lower that price goes, doesn't matter. It stays right at $13. And why is that? It's because I'm spending, wait, why is it 13? It should only be 14. I mean, it should be 14, because I'm spending 14 to get in. So theoretically, the most I can lose is the $14 that I'm spending in the first place. So it says 13. I don't know why. It should really be 14. So if it drops down to 27.13 per share, that's my break even, because the strike price here is at 27. I'm sorry, if it's not going to drop to 27.13. It would have to come up to that point. But if the stock closes at 27.13, oh, this is the wrong expiration too. Let's change this. This expires on Wednesday. I want to do the one that expires on Friday. So these prices are going to get a little more expensive because we have a little more time. Okay, now we're talking. Let's just delete all of that. Oh, let's go into Builder because that deletes it. Okay, and this reset. So we're going to go out to the 23rd. 5 days out. This is Friday. Okay, this is 5 trading days out. All right, so now we're looking at our stuff here. Now it's going to cost me 31 cents. See, now I might want to have that coverage out here to make it a little cheaper. So we're going to buy that one right there just outside of the money because I think the price is coming up. We're going to sell the call right above it, and that makes it cheaper to get in. Now I'm getting in for 13 cents. That's not bad. I have the option of making some money. All I need this thing to do is come up a little bit. Cool. I can make some money. Now, if I'm wrong and it goes down, my break-even point is 27.12. So I would actually need this in order to break even. I need this to come up 60 cents. And then anything over 60 cents, I start to make money. If it closes anywhere below that 27.12, I'm starting to lose money. I'm losing some of that $13 that I spent. And starting at $27 even, right here where this strike price is. If it closes anywhere below that, so if it trades sideways and closes exactly at 26.52 where it is now, I'm going to be out the entire $13. I don't know why it's saying 12. It should be 13. So I'm going to be out that whole $13, but I'm out $1,300. Now, if this comes up a little bit, and in this, it's a 50-cent spread, man. Okay, we got to change that. Now we'll run with it. Why not? So this is a 50-cent spread, meaning that I can only profit on 50 cents. So this one here becomes valuable to me. So for every dollar that the stock moves above this, I'm making $100. But because I sold this one, for every dollar it goes above 27.50, I'm losing $1. So once the stock comes up to here, I no longer make money because I'm making $1 and I'm losing $1 simultaneously. So if it goes to 27.50, if it goes to 28, if it goes to $300 per share, it doesn't matter. My winnings are capped. And if we look at our chart over here, they're capped at $38. And the reason for that is this is a 50-cent spread. I would have preferred $1 spread. We'll change it here in just a minute and see what it looks like. It's a 50-cent spread, and that's 50 cents per share. So if the price comes up through both of these options, then I made 50 cents per share, which is $50. But I spent my $13 to get it. So my maximum profit, again, it's listing 38. It should really be 37. I don't know why it's doing that. Doesn't make sense because I'm spending $13 and I'm not spending 12. But we would expect to make $37. And what do we need the price to do in order to do that? We need the price to come up $1. Actually, 98 cents. If this can manage to go up 98 cents per share anytime in the next 5 days, this week, then I make my $38. And if it closes at or below $27.12, I'm going to lose some of my money. If it closes anywhere below $27 even, so if it fails to come up 48 cents, then I'm going to lose my $13 that I'm putting into it. That says 12, it's 13. So there we have it. Now, I don't really want to do that. I like the $1 spread. It'll be a little more expensive to get, but we're going to do it anyway. So now instead, I'm going to say, I'm used to looking at the builder. I apologize. So now I'm going to actually look at it and say, where's the dollar? I'm buying the $27 put, call option, I mean, and so I'm going to sell the 28. And it's worth a few less cents, so it's going to cost me a little more. So now instead of spending $13 to get into this position, 13 cents per share, now it's going to cost me 20 cents. 20 cents per share, $20. So now our price, our profit and all that stuff changed ever so slightly. Instead of losing $13, we're losing 20. According to this, instead of losing 12, it's 19. There's got to be a rounding error or something. What is this? That doesn't tell me why there's a rounding error. At any rate, we're going to be out 20 bucks. I suspect that this is getting the total of the individual bid and ask spreads, and this is averaging like each one individually, or this one's individual. That's the total. I don't know. I'm not sure where the rounding error is coming from. But anyway, we would expect to lose $20. Because that's how much we're spending on the position. So our break-even point here, 27.19. It would actually be 27.20 probably. 27.19. So we need this to come up 48, 68, 67. I need it to come up 67 cents to start making money. And after that, we just make more money until it hits $28, which is where our other strike price is, right there. After that, for every dollar we're making here, we're losing $1 here. So that's it. That you have capped your earnings potential by doing this. You've made the trade cheaper to get into. Instead of paying 31 cents per share, I'm paying 20 cents per share. But I'm capping my profit, my income at $100, which means I'm going to have an $81 profit. It'll be $80 because I spent the $20 to make the 100. So in order to maximize this, I need it to come up to $28, which means I need the stock to come up $1.48 sometime this week. As long as this stock can go up $1.48, I will maximize my profit and I will realize an $80 gain. It'll be awesome. But let's now look at, get rid of this, get rid of that. Okay, let's go look at what might happen if I decided that the turnaround signals, the MACD and the RSI, yeah, you know, those guys are pretty right. It's gonna totally turn around. So now I want the price to come down. So now I can just buy a put. Calls gain value when the market goes up. Puts gain value when the market goes down. I'm assuming that you understand at least that much. If not, by all means, drop a request in the comments, and I can make other little videos for that. All right, so I want to buy a put. Here it is. Ooh, this is a little more expensive. Okay, so we're at 26.52. This is technically in the money because it's 26.50. This is 2 cents in the money. So it's a little expensive. Okay, that's cool. We're gonna go ahead and buy it anyway. Oof, 54 bucks. So this is a fairly sizable position now, because remember, my account only has $241 in it. My current purchasing power, because I've got an option already, is 192. So 54, that's pretty sizable. I might want to reduce that a little bit. So just like before, we're gonna create ourselves a spread. Now let's look at the builder. This would be a put debit spread. The debit just means that I'm spending money on it. The credit means that I'm bringing money in for it. I'm selling the spread or I'm buying the spread is the terminology. And this is just put. If I'm bullish, I probably want to do this. And it tells you right there. If I'm bullish, that's what I want to do. But now we're saying I'm bearish. I think the market's coming down. I want to do this. And you can click on this. You can change your width, you know, if you want to. Maybe you want the 50 cents. I like the $1. And now it's selling in pairs. 27.26. 26.25, so on and so forth, and it just calculates all that for you. It combines it into a single trade. That's pretty cool. I like Robinhood for that. I think they're pretty cool. But we're gonna go back, and we're gonna go back, and we're gonna do this manually just for fun. So I want to bump this out again to the 23rd. There we go. All right, so that's the current share price. I'm bullish. I want to buy a put, and we're gonna put it right there. Slightly out of the money. Actually, technically it's slightly in the money, but it's the first put option moving down the chain here. So 54 cents is what it's going to cost me. I want to reduce that a little bit though, and I like the $1 spread. So this is 26.50, so I'm going to come down to 25.50. Now I bought this one, so I'm going to sell this one. Now that's going to cost me 54 cents. I'm going to bring in 14 cents for selling this one, and that gives me a total cost of about 40 cents. 40 cents per share is $40. It's going to cost me $40 to take on this position right here. So now if we check our thingy here, my break-even point is 26.11. So because I am expecting the value to come down, I want it to come down. My break-even point is 26.11, which means in order to break even and not lose anything, I need this to close at about 40 cents lower than it is now. There it is, 26.11, so 41 cents. As long as this stock drops by 41 cents, I'm breaking even. If it drops by anything more, so this is the value going down. If it drops by more than that, up to where it drops down to 25.50, which of course is right here. And that's my maximum profit, because for every dollar I make here, I'm losing a dollar here. So that's it. Once it hits 25.50 or lower, I'm capped out on my profit, and that is $60. And again, it shows 61 right here, but it's actually 60 because it's going to cost me 40. Yep. So as long as it will drop to 25.50, and that means that I need it to come down by $1.52. So as long as I'm correct that it's going down, and it does go down, and if it can manage to pull off a $1.52 drop sometime this week, then I will cap out with my maximum profit of $61. If I'm wrong though and it goes up, well, as long as it closes anywhere above 26.11, I'm losing money. If it closes right at 26.52, right, oh, that is my break, well, 26.50. If it stays where it's at or goes up, I am going to maximize my loss at $39. So effectively, well, I'm sorry, it's going to be $40. Effectively what I'm doing is I'm risking 40 to gain 60 is what we're doing. So it's a matter of probability. If I'm risking 40 to gain 60, risk to reward of 2/3, that's not terrible. It's just a matter of the probabilities. So let's now say that I just don't really know what's gonna happen at all. I don't know if it's gonna come up or go down. So what can we do? Well, you could do a straddle. Let's get rid of this. A straddle is easy enough, and I think technically this is actually a strangle. We're gonna buy a call right here. So I'm buying, yeah, that's a strangle because they're separate. They're different strike points. They're only off by the 50 cents, so I'm buying this call and I'm also buying this put. If I bought both of them at the same point, which I would probably buy this one, then it would be a straddle as opposed to a strangle. But Robinhood recognizes that this is a strangle, so it changed it to the long strangle. Long just means that I'm buying it. It would be a short strangle if I were selling it instead. So if I'm buying those two, I'm buying this call and I'm buying this put. The break even looks like this. Worst case scenario, I'm out $85. And I guess I'm just going to read this number here. It says 84. Up here it says 85. We're just going to go with this. We're going to assume that it's right. So my max loss here is $84. My max profit theoretically is unlimited. The higher up it goes, the more money I will make. The higher down it goes, the more money I will make. The break-even points. Now this is based on the idea that I am spending $84 to get into this position. The break-even point on the lower end is $25.66. So if this comes down, I need it to drop down to $25.66. I need it to come down almost $1. It's around 94 cents, I would say. I mean, I would have to check my math, but almost $1. If this can come down $1, that puts me right into my break-even point. Anything below that, anything lower than $1 that this drops, I just make more money. And then on the upside, assuming that it goes up instead, my break-even point is $27.84. So $27.84, that would mean I would need it to come up by $1.32. So I need it to come up a little higher, and that's because I bought this call and I bought this put. So it doesn't need to come down as far. But it needs to come up, what did I just say? $1.82? $27.84, $1.32. So if the share price here sometime during the week goes up by more than $1.32, I've moved past my price point and then I start making money. And then for every dollar it makes, I make $100 because I have the one option on it. And this is, again, just a long strangle. So now if I want to cover these in order to make it a little cheaper to get into, like we just did before where I had this vertical spread and this vertical spread, all we're doing is we're combining that now. So now I want to sell the call that's one step out farther. And I'm also going to sell the put that's out one step farther. Oh, that's only 50 cents. I don't like that. Never mind. Let's go back. I'm not selling this one. I'm selling this one. And again, that's just because I like that $1 spread. If you were trading this and you wanted to get that 50-cent spread instead, hey, go for it. Do whatever it is that you feel comfortable with when you're trading with your money. But with me, this is what I want. I want that dollar spread. I'm willing to pay that extra 7 cents a share to get that extra $50 of potential profit. So I'm going to sell that one. And then we're also going to sell the put. And normally you would go one step farther. I want that dollar spread, so we're going to come down to here. So I'm going to sell that one for 14. So now my entire thing, and it says custom here, but I believe this is a iron condor. And just for some reason, Robinhood doesn't recognize that. Oh, that's why it expanded. How do you unexpand that? I don't know. That's a little annoying. Okay, so I believe this is an iron condor. If this were a strangle instead of a straddle, it would become an iron butterfly instead. And I'm pretty sure that's right. I could totally be mistaken, in which case, by all means, correct me in the comments so that everybody else who's watching can see the correct information. But I believe that's right. So now I'm locking in my profit. My profit on this side over here is $42. My profit over here is $42. And that's because my total spread is $100. It's $1 wide on each side. So the most, if it comes down, the most I can make is between $26.50 and $25.50. That's $1 times 100 shares is $100, and I'm spending, according to this, $58 to get into the trade. 100 minus 58 is 42. The maximum loss is if it closes anywhere between $26.50 and $27, which is exactly between this strike price and this strike price. Then I experience my maximum loss because everything expires worthless. All that money I paid out was for nothing. All the money I brought in, though, I get to keep the $25, but I paid out the $85. So my max loss here is my $58. So I'm risking effectively 58 to make 42. And again, your potential profit there is lower than your potential your potential loss. Oh my goodness, I totally misplaced my smart pills today. I apologize. But it's again all about probabilities. What's the probability that it's going to close between these 2 points, and do you expect it to move farther than that? You could invert the entire thing. Instead of buying this and selling this, you could sell this one and buy that one to cover. Flip the entire thing around. Now your profit is exactly inverted. Instead of this section being red, now it's green. Instead of those being green, now they're red. Now you want it to stay in this tight little area. Me personally, on the SLV, I expect this thing to move something close to or more than $1.30 at some point during this week, in which case I can close everything out and we make money. So there we go. There's the manual setup for the Iron Condor. Now here's what a lot of people may or may not go into when they're doing videos about this. I set this up as 4 different legs in a single trade. Now with Robinhood, with options, you are allowed to do up to 4 day trades. And what that means is if I put this in, it'll be executed on Monday. And then if I make my money, this thing spikes up, it spikes down, doesn't matter, and I accept this profit right here and just close out my entire position on Monday. That is a day trade. I opened and closed a position on the same calendar day. You're allowed to do up to 4 of those in a week, and then they'll lock your account if you hit that 4th one, and that's a rolling period. So I already have a day trade because I opened and closed a position on Friday. So you don't want to do too many of these. So I would expect to actually buy this position and then sit on it until Tuesday and then do whatever I need to do to move stuff around. So what I did though is I showed this as one single transaction. And if you were setting up an Iron Condor or an Iron Butterfly on Robinhood, this is what you would do. Now I want to be able to close out my losing position though. Or I want to be able to close out my winning position once it caps out its profit. So in this case, if SLV comes up to $25.50 or higher, I want to be able to close out this winning position, claim my winnings, and then wait to see what happens here. Because in a volatile market, you could actually see this one profit and then this one also profit. Sometimes the same day, sometimes in the same week. In this case, it would have to be in the same week because I'm getting options that expire on Friday. So I want to be able to close out this half without closing out this half, just in case. Because if you just allow everything to expire, assuming I don't close this out, if I don't manage this, or if it doesn't turn around and see some profit on this side, that $42 is my maximum profit. It is. Once I hit this point, we're good. And that's just assuming that you don't manage your position at all. But I intend to manage it. So what I'm going to do is I'm going to enter this as 2 separate orders or transactions. And that's going to be a little rough for me because that means, because I'm doing this on SLV, I'm also doing one on QQQ. That means that I will be entering 4 positions, not 2. And that means that at most, I can close out 2 of those positions on Monday, because this is going to open on Monday, without getting flagged as a day trader. Because in order to be a pattern day trader, is what they call it, you got to have $25,000 in your account. You can see that I do not have $25,000 in my account. So I have to watch my day trades. But the joys of options over something like futures contracts is that you can actually roll your options in such a way that you're not closing your position, but you're locking in all your profits from it. And that's something that we'll get into later. I just wanted to go through this little process right here. I think, though, that I am going to switch over. We're going to go to QQQ, and we'll actually place a trade. I am going to come back and place this trade as two separate trades, but first we're going to go over here. We're gonna go through this one just a little quicker. So we're gonna say trade options. The QQQ is an ETF. It trades. It tracks the Nasdaq. Is it the Nasdaq? I'm pretty sure it's the Nasdaq. Okay. So let's just check the price history real quick. I think this one is a little. Oh no, not the price history. Just kidding. Go here. And where's my chart? Where's my chart? Where's my chart? There's my chart. I found it. Okay, advanced. All right, so this one is a little different. This one is a little more convergent, especially on the weekly chart. See, everything is just packed up right here. we're experiencing a lot of convergence right here, so it's a big consolidation. Now, consolidations can go for from here to here is over the weekend. That's Friday. That's Sunday. So this had some trading on Saturday. And then from Sunday to Monday to Tuesday. So we have some stuff. This one here, that's interesting. Oh no, that is, okay, so right here is Monday. So Monday was a busy day, but Tuesday, oh, all of that is Monday. Okay, from there over to there. Okay, got it. Monday started out pretty busy, but you've got these points of consolidation. This consolidation, there's a little bit of chop right here, but it didn't really go anywhere. This consolidation, again, there's a little bit of chop, but it didn't really go anywhere. But this is probably far enough, depending on where you set up your strike points. Like with the SLV we just looked at, your long side might have hit profit right there. In which case, if you closed it out, then just sat on the other half, the other one would have hit profit too. It's possible to hit both of these. Same deal here. You could have hit your short one and then your long one right after, but then of course you're dealing with your potential pattern day trade thing. So ideally you would want to see this sort of chop happen after your order hits. Let's see here. This is opening on Wednesday. So if we were to put in our options thing trade on Thursday, see, we got this real tight consolidation here. This is not quite as tight, but it's still a consolidation. So if we opened up our condor spread here, this is pretty likely. Let's see here. That's 464.78. 460. That's a $4 spread. If I'm buying my options right outside the money and then I'm selling the coverage options $1 outside of that, that's a total of a $2 spread. It's not a huge spread. That's a $4 spread. So I would have been able to close out my bottom position, my short position, and my long position, both at profit. So, and that's what we're going to try to do. That's the whole point and purpose to doing this little thing. I haven't done it before. I have traded iron condors before, but I haven't done this particular setup where I treat the iron condor as what it is, and that being two separate vertical spreads, the call spread and the put spread. So I kind of want to try this out, and it seems like a good day to do this on the QQQ. I actually saw this one first, and then I looked at the SLV. And I kind of like the way it was starting to consolidate, so it's also a good spot to do that. And also with your consolidation here, it makes options cheaper, because what makes options expensive is a volatility. But as things come into a channel like this, and granted this is just most of Friday, Friday opened right here. So we had a bunch of down at the end of Thursday. Friday opens here, and it came back up, and then it just sort of consolidated from there. So it's pretty low chop. The options will be a little cheaper than they would be here. Right here you got some pretty heavy duty implied volatility, and so you're going to have more expensive options. And because I'm buying these strategies, not selling them, cheaper options is good for me. So let's go ahead and trade. Let's not trade there though. Let's go back. We're going to trade some options, and I'm going to step through this one just a little quicker because I went through the process on the last one. So I don't want to trade Monday. QQQ covers daily options if you're trading in the next week or two, which is nice. I do want to go for Friday, so that gives us 5 trading days. And I'm not using the builder. I could use the builder. Let's use the builder. This time we'll actually use it. So I'm doing the debit spreads again, but I do want both. So I want to call debit spread. There it goes. This reset for some reason. Okay, we'll set it back out to Friday. There we go. My width, I like that dollar width. Let's go ahead and get it. Okay, and that made it a little more expensive. All right, so now we're looking at something like having that spread is a good idea. In fact, you know what? Let's get rid of the builder. Go back. Because QQQ is going to be pretty expensive, go back to just buy the option. Okay, so here we are. Let's go back out to Friday. All right, now if I want a call option, I think this thing is going to come up. I just want to go ahead and buy a call option. It's going to cost me $5.02 per share. That's $500. I don't have that. I don't even have 200. At least in buying power. In buying power, I've only got 192. So with a small account, in this case it's more like a tiny account, with a small account like what mine currently is, I can't trade that option. I can't buy that option. So the only way that I can trade this is by doing this spread. I have to buy this and also sell that next one out. See, now I can get in for 60 cents a share, 60 bucks. I have $60, but I don't have $500. So the options are or rather the spreads are good to have. Yes, you're capping your potential profit, but you're enabling yourself to even get in the market in the first place. Whereas with the smaller accounts, you might not be able to trade these instruments unless you're doing spreads. So let's go back. Let's do our call debit. Changes back to Friday. Changes back to $1. There we go. All right, so I want my call spread right here. We're at 474.26, so this is 74 cents out of the money, but it's right next to the money. 55 bucks, bam. 55.06, because they're going to charge me regulatory fees per contract. So now we look at our profit here. My max loss is the 55 that I'm spending. Max profit is $100 minus that 55 that I spent to give me a $45 profit. Cool. And using the builder, specifying my spread and specifying my date, there's my strike price that I want, the 475, 476, and all that means is because I'm buying this, it's a debit, I'm buying the 475 and I'm selling the 476 to make the whole thing cheaper. So there it is, there's that. I'm going to say review order, and hopefully it's going to work. Buy to open, sell to open. This is what we want to see. You're opening a position. Opening a position. If I were trying to close this out, I would want that to be buy to close. And you would buy the one that you sold, you would sell the one that you bought. Just exactly backwards. It flattens your position. So I'm going to say submit. And there it is. There's an actual order placed on my live account. But I'm not going to stop there. I'm going to go back into the builder, and I want a put debit spread as well, because we're seeing that consolidation period. And that means that we're expecting it to move. I don't necessarily know which direction it's going to move. I want to be able to make a little bit of money in either direction. So here's our Friday. Cool. I want that width to be $1. There it is. And here we are at the strike price. So I'm sorry, the current price. The current price, 474.26. So I want the 474, 473. And just like before, it's a debit spread. I'm buying this. I'm paying money for it. So 474 is the one I'm buying, 473 is the one that I'm selling. I'm going to add that, and my total cost on this is going to be $38. So on this particular one, my total loss, if it drops down to, bink, where is it? There it is, 474, which is this strike price right here. I'm sorry, not if it drops down to, but if it closes at 474 or higher, anything higher than that, then I experience my maximum loss of $38.06. If it manages to go to 473, so drop all the way down to this strike price, now I'm making that full $100 minus the 38 that I'm in it, and I'm getting my $62 profit. So I'm in this particular case, I'm risking 38 to get 62. I'm putting up $100. I mean, I'm not. I'm putting up 38. So yeah, I'm actually risking the 38 to get 62. This one looks pretty good. Looks pretty good. It's just a matter of which one is going to pay out. The other one is a little more expensive, and that's because currently the market, the collection of all people trading the QQQ, believe that it's going to come up and so the rest of the market is generally bearish at the moment, and that's why the call options that are right at the money are slightly more expensive than the put options that are slightly out of the money. So we're going to go ahead and review this. Overall, $38. The other one cost me $55, so it's going to be $93. Yes, the whole thing should be about $93. Go ahead and submit that. Okay, cool. So hopefully this will just plain execute, because I want both legs to execute. And if you're looking for that, the alternative, and we're going to do the alternative right now with SLV. I'm putting in the order both ways so that we can see both ways. In this one, we're going to go ahead and do... Oh my goodness, why are you all the way down there? Actually, I don't need to look at the chart again. We already did. So here's the options. And I'm going to put these 4 in manually because they don't have an iron condor button. But what we're going to do is I'm going to buy a call right here. That's $1 spread, so I can sell the call right here. I'm going to buy a put right here. Oh, just kidding. I forgot to change my dates. We're going to have to redo all this. Okay, so the 23rd. There we go. All right. Do it again. Buy, put. Okay, so we're going to buy this put, and we're going to sell this put. Wait, what? You can only select... Oh, I got to close. Oh, my goodness. Close out everything. Start over. Okay, cool. August 23rd, 5 trading days. That's Friday. Okay, so we're going to buy a put right here. We're going to sell that put right here. Okay, so that side is going to cost me 25. Risking 25, potentially make 26. According to that, I'm risking 24 to potentially make 26. Oh, that's a 50-cent spread. Oh my goodness. No, I don't want that. I forgot this is a 50-cent spread. I want to go out $1, so I'm buying that one, and I'm going to sell this one right here. There we go. Now I'm risking 40 to get 60. Okay, cool. And we're going to put in all 4 parts of this one simultaneously as a single order. And this way I know for sure that this will get filled this way, whereas with the other one it might fill my put spread, but it doesn't fill my credit spread or my call spread, and that would kind of suck, especially if it goes up, because then I have my losing position, but they didn't give me my winning position. That would be terrible. But in this case, I either get all 4 of the parts or I get none of them. So we're going to go ahead and say buy call at 27. I want this one. And then I'm also going to sell a call. That's 27, so I want 28. We're going to skip and go to here. So this entire position, all 4, to make my little iron condor here, is going to cost me $60 to get into, which means my maximum loss is $60. According to this is 58. According to this, my max profit is 42. And I needed to go, I needed to close out either higher than $28 or lower than $25.50. And that's just because I need it to drop down through this spread, or I need it to go up through this spread in order to achieve maximum profit. Now with this one, we're going to go ahead and submit. This is a single order, and so all of it will be filled at the same time. But if it comes up through the calls, let's say it reaches, I don't know, 25.37 as the stock price, I would have to go through and manually close out my position on this. Meaning, go ahead and review that. See how all these say buy to open, sell to open, buy to open, sell to open? Those are my 4 legs. So if the call option becomes profitable, if the price of the stock of SLV goes above $28, if it's $28.12, $29, whatever, I would have to go in here and manually I have a buy to open for next Friday at a $27 strike price. I would have to sell that same option, and it would be sell to close. Same thing here. I've got I'm selling an option on Friday at the $28 strike price. I would have to buy an option on Friday at the $28 strike price, and that would be buy to close. And then I would be manually closing out this side of that iron condor. And then I could ride this out, see if it turns around and comes back down. I've got a week. As long as it comes back down at some point during that week, I'm going to be able to close this out. Maybe I'll be profitable, maybe not. Maybe I'll make less money. But if you're managing one side at a time, it will increase or potentially increase your maximum profit while simultaneously reducing or potentially reducing your maximum loss. So these options go through Friday. I intend to, whatever happens, have them all closed out by Wednesday, 2 days before expiration. So that being the case, I'm closing them out before. So it's going to cost me that $58 to get in, but I'm going to be closing my positions before then. So although I'm buying all 4 of these, let's just assume the stock trades flat, it doesn't move, it stays right at 26.52, doesn't go anywhere until Wednesday. I would have to sell everything I'm buying and buy everything I'm selling to close this out. Right now it's costing me $58. If I do that exact same thing on Wednesday, it's not going to be worth $58. It might be worth $38, in which case I'm out $20. But I'm only out $20. I'm not out 60. So that's what we're going to do. And with this particular little, I think I'm going to make 2 separate playlists. We're going to do like the Robinhood playlist and then the other playlist. And the money that we're going to put into the futures, I'm going to probably split that between 2 different platforms. I don't know which platforms I'm going to use yet. It could be AMP Futures. It could be Tastyworks. It could be... what do they call Thinkorswim now? It's still called Thinkorswim. Oh, Schwab. Schwab bought out Thinkorswim about 1.5 years ago or something like that. So I have brokerage accounts at all those brokers. It's just a matter of which ones I want to put the seed money into. Like with AMP Futures, in order to make an API, which I will be doing, I'll be accessing the API and coding a bot, and I will probably do a separate playlist for that for those of you who are programmatically inclined. Try saying that 3 times fast. So I'll be going through some of the coding that I actually do to code my own bot. In which case that requires access to API. If I am going to use the API, the application program interface, with Tradeovate, for instance, they demand a $5,000 minimum balance in order to access the API. Whereas with Tastyworks, you don't have to have that $5,000 balance. You just have to come sign up at the developer.tastytrade.com and register your app. And I think it's something very similar to that with Thinkorswim. You just have to register your app, in which case at least part of the money will be going to either Tastyworks or Thinkorswim, and then the rest of the money will go to a second broker, and I don't know exactly which broker I'm going to use yet, but there's your today thing. That's my thoughts and ideas and plans for this coming week. I don't know exactly when I'm going to get this posted because I got to get ready for work right now. So hopefully I get it posted, I don't know, by Wednesday anyway. I plan on getting this video posted tomorrow night after work. I only work 1 job tomorrow. So thanks for coming along for the adventure. I look forward to having you as we continue to progress. It'll be fun to see how much money I end up making or losing on these trades here. Go ahead and submit this. And that should reduce my buying power. Yeah, so my buying power is down to 41. It was at 192, so I ended up spending $151 on those 2 trades there. And we'll see what happens if they all get filled or if they don't. Monday morning I might be sitting out in the parking lot at my other job and trying to finagle the positions a little bit, because Robinhood tragically doesn't have the option to just say market. Everything's a limit. So they won't necessarily get filled immediately, and I might tweak that a little bit. If I'm doing it at work, though, I won't be able to record it, so I won't have video of it, but I'll at least keep you updated. After work, when I get home, we'll look at the positions. I'll talk about what I did, what I changed, if I changed, and we'll see where everything's at. It's going to be a lot of fun. So thanks for coming along for the adventure. Remember to drop me a like and kick me a sub. I really appreciate those things. I would imagine they help out. I don't know. I'm such a small-time YouTuber. I have no idea if it helps or not. Presumably it does. And I appreciate it if you'd help me out. And in the meantime, whether you do or not, I look forward to seeing you in the next one, because this is going to be a great and awesome adventure.